Hey everyone, in the past we've discussed a lot of fundamentally strong companies that are worth investing the money. But in today's video, I want to discuss companies that I avoid investing my money. The reason is because in today's bull run, the stock price of majority of companies is going up and it's very difficult to filter out the difference between fundamentally strong companies and weak companies. So in this video, I would share 11 criteria that can be used to avoid investing in wrong stocks. Please note that although these 11 criteria are good enough, there can be certain exceptions. And needless to say, this video is only for long-term fundamental investors, not for traders. Alright, let's get started. So my first filtration criteria is very simple. It's on the growth rate. I avoid companies with slow growth in top line and bottom line. I like to invest in companies where both sales and profits are growing at more than at least 15% CAGR rate for the last 3 to 5 years. I avoid companies that are not showing 15% kind of growth. Yes, there can be a phase of slowdown for the company or the entire industry due to internal or external reasons. For example, after a significant growth, IT and chemical sector companies have shown slowdown in growth. But that is due to external reason. The long-term story is intact. Overall, the company should have a good track record of growth in the past and should have the growth levers in place for 15 to 20% kind of growth in the future. Now, what are some of the high growth sectors today? So one of the fastest growth sector is electronics, where companies leading the sector are growing at 30 to 40% CAGR rate. Then you have defense, power, railway, infra, where there's a strong push from government. But growth is not the only parameter. A company might have grown at 40-50% rate, but it might still not be investable. So you have to look at multiple parameters including valuation. We'll discuss that shortly. By the way, the growth in top line and bottom line can be gauged on Screener website, where they show compounded sales and profit growth for 10-year, 5-year, 3-year and trailing 12 month. And you can also look at companies year-on-year growth in companies P&L for last 10-12 years. My second criteria is on margins. I avoid companies with very low margins as well as volatile or declining margins, because margin speaks a lot about company's business model as well as its strength. A low margin business where operating profit is say 2 to 3% essentially means there is no moat or differentiator in the product or service of the company. Otherwise, why would a company operate at such low margins? For example, there was a lot of discussion over Rajesh Export, where I also did a video and mentioned why I don't like this company. And one of the reasons was it's almost 0% margin business. Company sales are as high as 2.8 lakh crore, but its expenses are also similar. And hence the margins are almost 0%. It was 3% and then it declined consistently to 0% levels. This clearly signifies there is no moat in the business. On the other side, look at the operating profit of companies like MapMyIndia. It commands a margin of more than 40%. That has consistently grown over the last few years. Likewise, look at the margins of CDSL and CAMS. CDSL commands margins of as high as 60% and CAMS margins are as high as 40%. Here, please note that on Screener, you will find negative financing margin for banks and NBFC sector. So banking KPIs are a bit different and unfortunately Screener does not provide that comprehensive picture. For that, I look at individual investor presentation of each company. Then I also avoid companies with very volatile margin, where in a specific year margins are say 20% and then next year margins fall to say 10%. Then again margins zoom to 25%. Basically, it means company operate in a very highly cyclical environment. And one of the great example is metal sector. Just look at the margins of Tata Steel. In 2013, margins were 3%, the next year it zoomed to 11%, then it fell down to 2%, then again negative margin, then zoomed to 12, 17, 19%, then fell down to 12. In 2022, it touched peak margin of 26% and now margins are at 10%. Because of such volatile margins, companies' operating profits are also extremely volatile. In 2014, it made an operating profit of 16,000 crore and then in 2016, it was in loss of 625 crore. In 2022, its profit zoomed to 63,000 crore and then it fell down to 32,000 crore and now 22,000 crore. Due to this, companies' net profits are sometimes very high and sometimes in negative, because it is due to extreme cyclicity in metal industry, which is a commodity business and prices are driven by supply and demand. So personally, I avoid such highly cyclical industry, but if you have the right knowledge of the industry, then only you should consider investing. Otherwise, it's better to avoid such highly cyclical sectors. Then I also avoid companies where margins are on consistent decline trend. I like to invest in companies where margins are expanding. For example, look at the margin expansion in RateGain Travels. from 3% to now at 20%, and management has further guided for margin expansion till 25%. And when the margins expand, profitability zoom big time. Third, I look at profitability in terms of ROE and ROCE. ROE is return on equity and ROCE is return on capital employed. It basically measures company's ability to generate profit on the investments. The key difference between ROE and ROCE is ROE measures the return on shareholder equity, whereas ROCE measures return on total capital employed that include both shareholder equity and debt. And both metrics are equally important. Ideally, I like to invest in companies with ROE and ROCE above 15 to 20%. Anything below 15% is a red flag. Yes, it could be due to a temporary situation, but should not be a norm in the company. Again, you can get this information on screen now. Here, please note that banking and NBFC companies would show you very low ROCE, but you need to ignore it because ROCE is not a right metric in banking and NBFC sector. Only ROE is applicable there. My fourth criteria is on leverage structure, that is debt. I generally avoid companies with debt to equity above 1 unless it's a part of very prestigious business group like Tata's. For example, Tata Motor is an exception where debt to equity is more than 1, but I still like this company. Likewise, Tata Power also has debt to equity above 1, which is again an exception. But in general, I avoid companies with very high debt levels. One of the biggest reasons why I like the IT and digital sector for the long term is due to its almost zero debt structure. Majority of IT and digital focused companies have negligible debt to equity. Again, here you can't look at banking and NBFC sector because their business model is such that their debt to equity is always above 1. The biggest reason why I avoid high debt companies is because in the past, majority of cases where companies have gone bankrupt, it is due to high debt levels. Be it Kingfisher Airlines, Jet Airways, Reliance Power, and there's a long list. Because when you take high debt, you have to pay interest, no matter what is your profitability. And due to any reason, if the business does not perform well, you still have to pay debt and that can result in bankruptcy. Because of this reason, even Tata Motor share price fell down more than 90% in the past. Fifth criteria that a lot of people today are ignoring is cash from operations. I'm sure you would have heard the term in business, cash is always the king. And that is absolutely right. Because at the end of the day, you need cash to run day-to-day operation of the business. That includes salary payment, vendor payment, cash for inventory and so on. Now interestingly, a company might post a high net profit in its P&L statement, but in reality it might be struggling with cash to run its day-to-day operations. It could be because company is sitting on very high inventory or has very high receivables from debtors. So when you do your research, always check the cash from operations section on screen up. This is the example of Mishtan Food, where company is consistently posting negative cash from operation, where if you look at its net profit, it's always positive. Now, if you expand the cash from operations, you'll find that out of 356 crore of profits, company has a receivables of 371 crore. That is a big red flag. On the other side, look at the cash flow of companies like Nestle. Huge cash from operations. In fact, it is one of the reasons why companies like Nestle command a premium valuation, because they are cash generating machines. So always avoid companies that have consistently generated negative cash from operations. Again, there can be some exceptions with high growth companies. For example, Zomato was consistently posting negative cash from operations, but its story has turned around in 2024 with very high cash. And I expect this to continue in the future. Likewise, Nykaa is posting positive net profits, but its cash from operation is negative, although the loss has narrowed significantly. So there can be some cases where cash from operation is negative due to high growth stage of the company. But you need to be careful in selecting the companies. As a rule, try to avoid companies with negative cash from operation in the portfolio, with very few exceptions with turnaround story. Now, so far we have discussed the parameters that can be easily scanned on screen now. However, there are a few other factors that also create red flag for the company. And one such parameter is frequent change in leadership, including company's CEO, MD and CFO. Because frequent change in leadership suggests instability in leadership. And leadership is one of the most important aspects of the company because its leaders set the vision for the company and work towards achieving the vision. But if leadership would change frequently, company would lose its focus. So when you invest in a company, always check its leadership detail and ensure that they are associated with the company for a long period or at least have a good track record in the past. And if the previous leader has resigned, you should have a fair idea behind the resignation. Then seventh criteria is frequent change of auditor. This is again one big red flag. Frequent change in auditor suggests that there's a high probability that company's financial statements are not compliant with the norms, probably the books are cooked, or even there's a conflict in interest between the leadership and auditor. One big example is Brightcom, also known as BCG. So you would be aware that BCG got delisted from stock market and became a huge wealth destroyer. But there were already signals with resignation of its auditor last year. Not only that, company's CMD and CFO also resigned last year. These signals are good enough to identify something is fishy, a big red flag. The next big red flag is criminal or illegal charges against the promoter. Again, a good habit is to simply search for promoter history before investing in the company. Simply type the promoter name on Google and use keyword criminal or illegal charges. That would help you identify if promoters were involved in any illegal activity in the past or not. If yes, it's a big red flag. The ninth criteria is the one that I always check while investing my money. Basically, I look at institutional or HNI holding in the company. If there are no FIs or DIs holding, then I become very suspicious. My logic is that if a company is very promising, it would certainly come under FIs or DIs radar. And if DIs and FIs are not invested in the company, then there is high probability that there is something fundamentally wrong with the company, which probably I am not able to identify with my research. Yes, there are exceptions where companies with very low market cap of say below 1000-2000 crore would not have FIs or DI holding. In that case, it should at least have HNI holding in public section. If there is no FIs or DIs or HNI holding, I like to stay away from the company. A lot of naive investors think that they have identified a new multi-bagger that no one else could identify before. But the probability of you identifying a new multi-bagger that no one else has identified is next to zero, unless you personally know the promoter of the company. In many cases, microcap companies are operator driven and they jump a lot. This results in attracting eyeballs of retail investors and they end up buying at higher levels, which eventually result in a trap. So next time when you invest in a company, always look at DI and FI stake for the company with market cap of below 5,000 crore and look for HNI holding if market cap is below 5,000 crore. There should be either FI or DI holding or HNI holding in the company. This information you can easily check on screener in their shareholding pattern. I also like to avoid companies where promoter holding or institutional holding is reducing and public holding is increasing, because in that case, the probability is high that there's a fundamental problem with the company. There are multiple instances where company got into trouble and institutions reduced the stake, but public ended up buying them. One great example is Yes Bank in the past. Public holding in Yes Bank was below 10% in 2017. That got increased to as high as 45% when its share price tanked more than 90%. But when the company started recovering, public holding started falling. So in majority of cases, public always do the opposite. They buy weak companies and sell strong companies. Now 10th criteria is again extremely important, which is very relevant in today's time. So far we discussed the criteria to check the fundamentals, but then comes the price. Even if the company is fundamentally strong, you can't buy it at any price. So 10th criteria is I avoid companies with extremely high valuation. Now this is one of the most complicated subject because valuation can't be measured just by looking at a specific metric. One of the most common valuation metric is PE ratio, and general understanding is that if PE ratio is below 25-30, then it's reasonable, and if it is above 25-30, it's expensive. But that is only good on paper. In reality, it is not true. And that's where I have recently done a detailed video on valuation analysis. This was one of my most valued video recently, but unfortunately it did not get enough views that it deserved because majority of people on YouTube are only looking for stock tips. Very few people want to learn the art of investment. So in case you are willing to learn valuation, do check out my video on valuation analysis. Specifically today, people are investing in hot themes without even looking at valuation. Now it may happen that some of the expensive companies can continue to rally and you get tempted to buy them. But in that case, valuation would become even more expensive and that would not end well. We have recently seen how chemical companies zoomed exponentially during COVID and became super expensive and then tanked badly. So make sure that you invest in fundamentally strong companies but at fair valuation. There's no point paying a PE of more than 100 even if the company is growing at a fast rate. Of course, there are exceptions where the company's earnings are growing at significantly high rates. My 11th criteria is specific to banking and NBFC sector where I look at NPA and loan book breakup and avoid companies where NPA is increasing or loan book is very risky with unsecured lending. This information I get in company's investor presentation that you can fetch from screener document section. So in this video, we discussed 11 criteria to avoid bad stocks. If I summarize, the list include slow growth or volatile growth in top line and bottom line, low and volatile margins, then ROE and ROC below 15%, debt to equity more than 1, negative cash from operation, frequent changes in leadership, change of auditors, then criminal or illegal charges against the promoter, then no institutional or HNI holding, then super expensive valuation, and for banks, high NPA and unsecured loan book. Please note that there will always be a few exceptions in this list. For example, one company is Max India, where I did a video in December month last year and it had very poor financials. Yet I mentioned that it looks very promising and discussed the reason for the same. Likewise, Sammy Hotel has consistently posted negative earning, but it is because of its business model that required high investment, and recently company has become profitable. Likewise, there can be turnaround stories. So you need to understand the business, its future potential, and sometimes need to take call beyond the numbers. Having said this, the rules that I have mentioned are very much applicable in majority of cases and would ensure that you don't end up investing in fundamentally weak companies. I hope you'll find this video useful. I've also got a close community of long-term investors where I share one exclusive video every week that includes sharing latest macroeconomic update as well as investment ideas, including the company where I'm personally investing my money. But that is again not a buy or sell call. That is just to share my own conviction and my investment style for long-term wealth creation. You can get the detail on my website or via the join button on this YouTube platform. If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.